Almost every country in the world today has a central bank. In fact, there are only two countries in the world that have their own currency and do not have a central bank. And those are Tuvalu, with a population of just 9,500 people, and Kiribati, with 132,000 people. Now, despite being such tiny counterexamples, they realistically also both generally default to using the Australian dollar for most serious transactions anyway. The reason that central banks have become a nearly universal feature of every economy on Earth is because they work, especially in our highly integrated global economy, with dozens of floating fiat currencies. They have become a check and balance on economic recklessness. They are an emergency backstop in times of crisis, a partially independent regulator on inflation and employment. And beyond that, there are the slightly more boring aspects of central banks as institutions that handle a lot of the administration that goes into keeping a currency functional. These are all jobs that have become significantly more difficult in recent years. As the world becomes more integrated, debts continue to balloon, and inequality undermines the tools that these banks have to work with. And of course, to make matters worse, all these responsibilities have been called into question as the U.S. government has tossed up the idea of scrapping the Fed altogether. Something that's caught the attention of everybody, from global bank executives to conspiracy theorists that think the whole show is run by lizard people. Now, from the get-go, realistically, this is very unlikely to actually happen. The Fed is the most powerful financial institution on the planet, and unwinding its place in the global economy would be borderline impossible. But it's also not without precedent. Central banks have been abolished before, including in the USA, and what's more is that the actual effectiveness of these institutions has been called into question more and more, as they not only have to tame their economies, but they are increasingly often at odds with their own governments to do so with such powerful institutions acting in such unintuitive ways with so much of a consequence on our everyday lives. It's almost understandable that people just assume that something sinister is going on in these places. So, if for no other reason than to get a better idea of what these central banks actually do, could the US get rid of the Fed? What would that do to the global economy? And finally, what are the more immediate problems that central banks are facing? When you're reading the news shopping online or just watching videos like this one, it's easy to forget that the internet wasn't really built for privacy. Behind the scenes, companies track your data, your internet provider monitors what you do, and depending on where you live or travel, governments might too. That's why we use Surfshark. It's a VPN, a virtual private network that encrypts your internet traffic and hides your real IP address. Basically, it keeps what you do online private. But it's not just about protection. It's also just a useful tool. For example, when we're researching videos, Surfshark lets us switch digital locations so we can see how different news sites or markets look from other countries. It's the same trick people used to get better flight deals or access to region-locked content on Netflix and other streaming services. There's also a clean web which blocks ads, trackers, and malicious websites before they even load, saving your time and keeping your browsing experience smoother. You can install Surfshark on unlimited devices. And there's a strict no-logs policy so your data stays yours. Right now, Surfshark is offering economics. Explain viewers a special deal without code. You can get 4 extra months for free. Go to surfshark.com/economics or use code economics at checkout to get 4 extra months of Surfshark VPN. Now, to understand what central banks like the Fed are supposed to do, one of the best places to start is with the historical problems that necessitated their formation. Now, to be completely honest, this video is already going to be quite long. So, if you already have a good understanding of financial history, feel free to skip to this timestamp here. A very brief history of central banks is that they informally started with European banking houses set up by cities to manage their debts and issue coinage to facilitate easy trade. The first formal central banks were the Bank of England, established in 1694, and before that the Sveriges Riksbank of Sweden, which was established in 1688. This is the same institution that awards the Nobel Prize in Economics. Is a fun little side note in these early days. They still hadn't quite grown into their role, but they were still operating as a bank for banks and for the government, as well as managing a universally recognized currency, which made commerce within these countries much smoother. The US actually had a similar kind of early central bank, starting all the way back in 1791. Alexander Hamilton awarded a charter to a bank that was founded partially by the government and a group of private investors to remove frictions in the financial system. It would also distribute and manage a universally recognized currency that people could trade freely with across all of the new United States, confident that private banks would accept these notes because the First Bank of America back in Washington guaranteed them. However, this first bank was abolished in 1811 because its charter was not renewed, but then it was brought back again in 1816, before it was once again abolished in 1836 because the president at the time, Andrew Jackson, did not like how much power the institution had, something that would become a common theme amongst a lot of central banks and presidents into the future. Now, the thing with these banks is that they were just regular banks with a profit motive and special privileges given to them by the government. This made it hard for them to balance the priorities of returns to their investors with doing what was in the best interest of the new nation, while also ensuring that they didn't anger lawmakers who could take away their charter of special privileges. They were compromised at best. Unfortunately, after they were abolished, things didn't get much better, as basically every regional bank started issuing their own depository notes, which made trade difficult because there was no guarantee that one bank would accept another bank's notes. And with so many different pieces of paper, circulating around, forgeries were rampant now at this time. It was important to remember that the US dollar technically already existed, but there was no paper notes, and the actual coin into is too limited to be used practically for day-to-day commerce. So private banks made up their own, and people just accepted the numbers. They wrote down on those pieces of paper. Realistically, it's not too dissimilar from today. If you really think about it, we don't carry around paper notes anymore. We have electronic bank accounts with numbers that a private banking institution writes down for us. We assume that the numbers in our bank accounts will play nicely with the numbers in other banks. And instead of being secured by designs that are hard to forge, it's secured by electronic systems that are hard to hack. But hold up a bank account on the phone and all private paper bill, and it would be very hard to explain the difference to an alien. Either way, these issues all came to a head in 1907 with a run on these independent, over-leveraged, and poorly regulated banks, which nearly crashed the entire financial system. A group of financiers, led by J.P. Morgan, acted as a lender of last resort to give these failing institutions enough cash to continue their operations. But this showed the clear need for a more formal, centralized system to stop the same thing from happening again. This led to the formation of the Federal Reserve Banking System of the United States in 1913. 20 years later, gold convertibility was suspended for citizens, and the paper US dollar as we know it today was truly born. At the time, this new institution only really had one responsibility to avoid bank runs, like what happened in 1907. It did this by being a place for private banks to deposit their cash and then lending money to any member bank. If they saw a big spike in withdrawals, that they didn't have enough cash on hand to fulfill. This would avoid a situation where a bank had to reject withdrawals, which would cause a panic on the entire system. Now, this admittedly oversimplified history lesson is important because throughout their different incarnations, they were all trying to do one thing: create a reliable and flexible medium of exchange, which meant distributing, protecting, and managing a currency. Now, some versions of a central bank were more successful than others, but this was still the end goal over time. As more and more countries adopted their own central banks, it became clear that by being a bank for banks, they could achieve other goals in the economy as well. They could control inflation, which was just a function of how much of their currency was needed for a given amount of goods and services. But they could also indirectly control employment, which by extension also meant economic growth in the USA. These responsibilities were formalized in 1977 as the dual mandate to stabilize prices and maintain maximum employment. Most central banks around the world have similar responsibilities, who usually listed on their website, if you happen to be interested in looking up what your bank is formally working towards. So, how do they do this?